look at funding sources and why it is important for business growth. I'm going to request that I share my screen. Just give me a minute to share my screen. Confirmation that you are able to see my screen in presentation mode.
It's not in presentation mode.
Okay.
But we can see it.
How about now?
Yes, it is.
Okay, thank you so much. So ladies and gentlemen, I'm going to try and utilize a maximum of 40 minutes such that I can have a bit of time for those who may want to comment and ask questions. So I was requested to talk about funding sources, specifically why it is important for business growth. I want to use a context starting from what we're going to cover during this session. I'm going to start by introducing the meaning and relevance of funding, the different classification of funding sources, the major funding sources. Then lastly, I'll look at how you can match these funding sources to business growth along what we call the organization cycle. When we think about funding, you need to start from any enterprise. For any organization, there are demands in terms of resources, and these demands will originate right from the idea stage, or what you call the inception stage. When you come up with a business idea, definitely there will be resources that will be required. As entrepreneurs, you know that you have to legalize the existence of your organization. So right from that point, you'll have to generate resources from a particular source to enable you meet the demands. And the rate at which your organization will demand for resources will keep on oscillating as you move from one stage of what you call the business life cycle to another. Shortly, I'll be talking about what we mean by business life cycle. Now, all these resources will usually demand money. And the supply of money is also going to oscillate as you move from one stage of the organization life cycle to another. If you do not manage these risk demands against the resources that you have, then you are likely to have business failure. So that already points to the fact that it is very important for you to manage the sources of funding for your organization. Now, I'm going to turn briefly to an introduction to what we call the organization life cycle. Generally, organizations go through different stages. However, there is what we call rule of thumb. Rule of thumb means acceptable. That if wherever you go, people will say that is okay, even if there's no scientific evidence. What I mean by this, if someone tells you 1 + 1, scientifically that means 2. However, if someone asks you a question like, say, compare democracy in Uganda and democracy in Rwanda, even if you carried out a study, people will give you their views. And if you find that a reasonable majority keeps ranking one country over the other, then it would mean, by rule of thumb, that other country is more democratic than the other one. So that is the rule of thumb. Now, rule of thumb is that organizations go through 4 stages. I'm going to briefly talk about this. The first one is what we call startup or infancy or introduction stage. Now, that's when you have your business idea, you are just starting off, you are registering the organization, you are establishing yourself, you are trying to find a footing within the industry. That is the infancy stage. Now, the growth stage is usually at that point when you have established yourself as an organization and you are trying to solve business. That's where you start looking for business through bidding and so on, because you have put the legal documents in order, you have established yourself. Then after that, we have what we call maturity stage. The maturity stage is one where there is stability within the organization. So you have established yourself, you have systems in place, everything is moving on based on the procedures, processes, policies, and so on. The internal controls are all established. Then the last stage is what we call the decline stage. That's when you are at a stage where you have reached an extent that you need to reinvent yourself as an organization, maybe enter into different other business portfolios because you have almost exhausted your current market. Now, for each of these stages, you will find that the different demands and also different cash flows. And by cash flows, I mean, because we said it is resources will demand money. So there would be inflows and outflows that may not be matched at each of these stages. And when that happens, it means you must source for funding. Now, just for contextualization, it does not mean that these stages are based on age. It's not like maybe after 5 years you will progress to this stage. No, it depends on the way you manage the organization. An organization can remain in infancy for more than 10 years. For example, some of you may have had business ideas, even registered businesses, but somehow those businesses have remained in limbo for a long time. You never opened up a tax identification number, you didn't bother with registration with URSB, and so on. So it remains in limbo for a very long time. So even if it's 10 years, it will still be at infancy stage. Yet there are others which are started and almost within 1 year, they have progressed from infancy to growth. 2 years down the road, they've gone through maturity and so on. When you reach decline, normally it means you have to come up with other ideas because you have kind of outgrown the market that you supply. So these are the stages that I'll be using for purposes of explaining. I want to demonstrate here briefly what the demands in terms of cash flows will be. So just excuse me a minute. I'm the one who has stopped the sharing, but I'm going to share again to be able to demonstrate the demands. So let us assume that here we have a graph You'll excuse my handwriting. And this graph shows cash flows. These are cash flows. And here we have stage. I want to squeeze the stages up here. So this is infancy. This is growth. This is maturity. And then decline. Now you'll find that when it comes to the cash flows, usually right from infancy, there will be demand for resources, registration, and all those other related activities. They may reduce over time, then they may pick up. This is not scientifically determined. I'm just demonstrating for clarity. Now, these are outflows. Outflows. Now, assuming we compare with the inflows. Now, the inflows, usually when you are in infancy, you may not even get inflows. But just in case that you start getting some inflows, let's say they behave like this. So these are inflows. Now, what you notice is that at a particular point, before you reach here, you have negative inflows because the outflows are in excess of the inflows. Now, from here going forward, you have positive inflows, meaning that your inflows are greater than the outflows. So definitely at this other stage, before you reach that point, you'll need some kind of funding. How you source for it, we're going to look at the different sources, but just know you'll need some kind of funding. When you cross here, you may find that the inflows are in excess of the outflows, but still there could be what we call timing differences. What do you mean by timing differences? Let us assume in a particular month, you have your inflows at 20 million Uganda shillings, which you will generate at the end of the month, let's say 30th of that particular month. But within the same month, you need to spend at least 10 million shillings. Of course, from this understanding, someone can see that you have positive cash flows. However, the inflows are coming in at the end of the month, but you may find that the outflows are supposed to be incurred within the first 10 days of that month. Now, that means even where you have positive cash flows, you may still find yourself looking for a source of funding. The reason being that the timing difference, even that positive cash flow may not be evenly spread over a defined period. So I'm just trying to emphasize the fact that when it comes to the funding sources, it does not end at the point where you have negative cash flows. Now, let me get back to the earlier presentation and then share the the different classifications of the funding sources. So in principle, we categorize funding sources into 3 different categories. There is what we call basis of ownership, then based on the generation source, and lastly, on the duration. Here I have some kind of an image, which I'm going to use to elaborate a bit. When you say on the basis of ownership, usually we talk about owners' funds, which is normally called equity. And then we have borrowed funds, which we call debt. Now, this is possibly the best classification because it gives you a clear understanding of who owns the resources that you are going to use in your organization. Now, linking it to our growth as an organization, I want you to remember this. When you talk about owners' funds, that is equity, it means that you are looking at a source that may be lenient to the business. What do I mean by lenient? It is lenient in that when you use equity, you will have an opportunity to get time to generate a return. What I mean by this is if you use share capital, which is equity, there is no standard amount or cost that is expected. In other words, you are not going to say every month I must pay the shareholders so much. That gives the organization a bit of room to maneuver. However, you need to be aware that this is a costly source because it is the return. Now, this may not be so clear, but what one should know is that when you use owners' funds, then the profit you generate is shared with those individuals that own the funds. Now, when you compare with borrowed funds are cheaper, but they do not give you room to maneuver. What do I mean by this? When you raise borrowed funds in form of a loan, the easiest is the loan, there would be a standard fee that you'll pay per month or per defined period. If someone says the interest rate is 15%, then every month you have to pay that 15%. If it's per month or if it's annual, it doesn't matter. I'm just using it for elaboration, for clarification and ease of elaborating. That means every defined period you'll be paying that amount, regardless of whether you've generated a return or not. So that's what I mean by it doesn't give you room to maneuver, but it is cheaper because you already know the cost, and at the same time, you can get rid of it when you feel that you have enough resources or if you have an alternative source. And I said on the basis of ownership, it is the best of classifying. I'm going to run through the others quickly, but the one of equity and debt, I wanted it to be clear because when I'm explaining the actual funding sources, I'll be relating to this. Based on source of generation, we talk about internal sources and then external sources. Of course, internal simply means that either you generate the funds from those who are already within the organization, that those are the members or shareholders who are already in there, or you as the promoter, for lack of better word, the promoter or the one we normally call the business owner, you are the one injecting in funds. Then external means you are bringing in other individuals who are outside the organization. Those who do not have a stake are the ones that are giving you funding. Then on the basis of term or duration, that simply means whether it is long-term, short-term, or medium-term. Usually short-term, we talk about 1 year or less than 1 year, 1 year, 12 months and below. Then medium-term, it depends, but usually we look at beyond 1 year, but not exceeding 3 years. Then long-term, usually we go beyond 3 years. But this may differ from one entity to the other, because if you look at an entity, let's say if you are into exploration of oil, your long-term may even be beyond 10 years. But if you are looking at a grocery store where you are buying items that are perishable, then your long term may be a lot shorter than for the other organization. So what are the major funding sources? Now, based on the stage of the organization, which you remember, we talked about infancy, growth, maturity, and decline, you will definitely find that different sources will be attractive depending on that particular organization, where it is in the life cycle. Usually the attractiveness is going to be defined by the ability of the business to meet the demands of the fund providers, but also reconciling the same with the demands for funding. Because those who are giving you funds will look at different aspects of the organization, and then they'll make specific demands. You as the owner or the business promoter, you also have to look at what do you want in terms of funding. What do you want funding for? And that will definitely determine the kind of source that you'll go for. Now, for you to be able to reconcile these two, then you'll have to look at where you are in the organization life cycle. Usually, your ability to meet the demands of the fund providers while also meeting your individual demands as an organization will be the major factor that will define how small or narrow the possible sources of finance are, or how broad those possible sources will be. And usually, this will increase as you go through the different stages of the organization life cycle. Now, sometime back, I think that was around 2017, I carried out a study among what we call the top 100 SMEs in Uganda. And I used the life cycle stages to look at the funding sources that they have. And this is what I came up with. I'll try to use this for explanation purposes. If you look at the infancy stage or startup stage, or before that, you will be able to notice that for all stages where I've put the red, there's a blue line in the middle here that represents equity. If you recall, equity by the shareholders. So that cuts across, because even when you're registering an organization, a business, they'll ask for share capital. So that was found to be common at all stages. But you look at the other sources. Now, a map of those sources shows that, for example, at the startup stage and family contribute a lot as a source of finance. At the infancy stage, you will notice that even at the infancy stage, credit also features. Now, for purposes of explaining, friends and family simply means where you go to your friends and family members to support your business venture. Interestingly, it's a very common source of funding for businesses in Uganda. Now, later on, you may appreciate that this differs because friends and family may actually be equity, but it can also be debt. If the people are giving you that money want a stake in that business, then it will become equity. But if they just extend credit and they tell you pay back after this period, then actually it is debt. There are also instances when it becomes a grant. that they just extend financing and you don't have to pay back. So those are variations, but I'm showing you what I found out. Others which are common, you'll see bank overdrafts. They are common at the startup stage, also features at the growth stage. They are, I think that is where they are. I don't know if they feature anywhere else. But bank overdrafts is also a source of finance, which would qualify to be what we call short term, because you get money from a financial institution beyond what you have on your bank account to ensure that you transact your business. You notice that friends and family also features in the growth stage. Then between the growth stage and maturity, long-term bank loans come in, short-term bank loans, trade credit. Now, trade credit simply means where you get goods from your suppliers and you pay them later on. It's a very interesting source of finance because you don't pay interest normally, as long as you meet your obligation after a defined period. Then hire purchase, I'm sure you are all familiar with hire purchase, but it simply means where you acquire an asset and then kind of pay over a period of time. That one does not feature maturity, but at maturity stage it was common. Venture capital. Venture capital simply means where individuals or firms invest money in usually a startup or an organization in return for either equity in that particular organization when it starts generating a return. Trade credit, we've already talked about it. Bank loans, short-term bank loans, these were long-term. Then lease financing. Lease financing is also a common source of finance where you acquire assets on the basis of a lease. So, for example, in the printing industry, you may acquire a printer or a printing press, and then you pay over time. Usually it's an arrangement between a financial institution and a supplier. So you need a machine from Germany, you approach any financial institution, the financial institution transfers the amount to the supplier delivers the equipment, then you start paying the financial institution. So venture, I've already explained this one. So those are the different funding sources that I found out in that study to be common among small and medium enterprises. Plotted on a life cycle continuum, this is similar to what I've just demonstrated. You find that equity is common across all stages. Trade credit features, but usually starts from somewhere as you are exiting the startup stage. You've noticed that friends and family features startup and growth, long-term loans, and others. So those are the different funding sources which are common to small and medium enterprises in Uganda, at least as at the time of that particular study. Now, when we combine the funding sources and growth, what do we notice? Definitely, as the farm grows, it will demand huge amounts of resources. And the internal sources, the capital, the share capital, the amounts generated by the individual promoters will reach a stage where they are not sufficient to cover the demands of the organization. So this will cover you for only a short period of time. What does that call for? Definitely, it calls for being innovative, looking out for ways of raising funds in order to support that growth. And that's where you now start looking at the external funding sources because you'd have exhausted your internal sources. That's why you notice that at the infancy stage, we have equity, family and friends. Then as you progress, even the friends and family sources will not be sufficient to cater for the demands that you have in terms of financial resources. So you go beyond your internal sources and look at the external sources. Now, what may be important is for you to remember that you must reconcile the interests of the organization with the interests of the fund providers. In my professional life, I've seen so many organizations that go and acquire short-term funding, yet they expect a return from what they're going to spend that money on over a long period of time. That means you are setting up the organization to fail. If you get an overdraft and then you decide to construct rentals, which rentals are going to generate a return? Actually, on average, we say rentals will bring back a return within around 12 to 16 years. Now, an overdraft must be cleared within a period not exceeding 1 year. But you are investing in a venture that will generate a return after a period exceeding 10 years. So what will happen? Next time you see court beliefs coming to foreclose, they take up the rentals you have constructed, they dispose of these rentals at the lowest fee possible for them to recover the amount that is due to the financial institution and also cover their operating costs. So that's what I mean by reconciling the interests of the fund providers and those of the organization. If you don't do this, then you are setting up your organization to fail. So beyond that, we have other funding sources that you may have heard about, and maybe you may be interested in knowing what they are. First of all, I want you to remember that even the classifications I talked about of debt and equity are basis of source and then the period. They are not exclusive, or they're not exclusively defined. In other words, it doesn't mean that the moment you have it under debt and equity, then you cannot rearrange the same under source, or cannot rearrange the same under duration or term. So you'll find that some of these, which we call funding sources, may actually be methods of generating money, but then the amount they generated would qualify to be under a certain classification. I'm going to use this to explain what I mean. For those who have looked at literature with an American bias, you'll find that most of their startups usually use what we call bootstrapping. Now, bootstrapping simply means a method of funding your organization whereby you use your resources and the resources that are closest to you. Now, this means you can use your savings, you can use a garage as your office, and you've heard of so many companies that started up in garages. You can use your car, your personal car, for business. So what you are doing, they call it bootstrapping. But now, when you look at it from categorization or classification, that amount can qualify to be equity if you decide to keep it in the business. For example, if you say this car, I have actually dedicated it to the business, then it would imply that that is the equivalent of equity. But if you say, I'm using bootstrapping, but I'll get back this money from the business. So in other words, you put in your savings and later on you retrieve it, then it would qualify to be debt. You have sourced for debt, but from yourself as a promoter. The next one is crowdfunding. This is very common for social enterprises, but even for other enterprises. This is where you source for funding from people whom you do not even know. But you make an appeal for a particular purpose, and those who feel that it is appealing to provide you with money will do so. Again, this may be equity or it may be debt, depending on how you have structured the crowdfunding. Because if you say you are going to crowdfund, but the amount you get, you refund it, then that means it's debt. But if you find that the amount is not refundable, then it will be like a donation to the business, in which case it's now your money as a promoter, and it will be equity, especially if you do not take it out of the business. Of course, we have grants, different sources. You can have government grants, other grants of different categories. Some of them may be like typical donations, but some of them may be that you have to pay back without interest or even with subsidized interest. Again, that can be another source of funding. We may have what we call asset securitization, also commonly referred to as mortgage financing. That is where you use an existing asset as a source of financing. So you are saying the amount that you are getting is strictly mortgaged against usually physical asset, usually let's say a house. So whoever is providing this funding, maybe it's a business location, business building, they will pay the amount to the supplier or the constructing agent, agents or whoever owns that building, they'll pay that amount. Then you own that building and you start servicing it, you start servicing the mortgage over time. So that very asset is the one that is acting as collateral in case you default. But the moment you clear your obligation, then you actually own it. Then we also have what we call business angels or business angel finance. This is where you have an organization or usually individuals. Let me use individuals because it's more common with individuals. Some of those high net worth individuals with a lot of experience in business who may look at your business idea and from the experience they weigh and believe that it's a very good business idea, then they invest money in your business idea, possibly with the return being expected. Now with business angel finance, it may have different arrangements. Some business angels simply invest and they let you manage your business until such a time when you've agreed that either you pay them back or they become shareholders. Others actually come and participate in the management. And usually these high net worth individuals have lots of connections. You can think of guys who have been in business or in employment for a long time, they've retired and they have their cash stashed somewhere and they can afford to give it to you as capital, not capital per se, but as a source of funding. So those are some of the sources that I felt I would discuss with you. And like I said earlier on, I intended, and I believe I've used 40 minutes to ensure that in case there are some comments or questions, I give you an opportunity to raise them. Thank you.
Thank you so much, Dr. Paddy, for the insightful presentation and sharing. At this point, I would like to welcome any persons with questions. If you cannot speak, maybe you can type in the chat and I'll be able to read out your comment or your question. Or you can raise your hand and then ask your question. Tinya, you have your hand up.
Yes, thank you, team, for the good job, and most importantly, the presenter. My name is Robert Mugambe Tinyefuza. I'm a data scientist and I work with Fortmat. Fortmat is an online advertising platform that was created in 2015 with an agenda of having information available for those who are in need and those who are selling products. My insights are a little bit few. Sir, I would love to know what would be better in regards to getting the finance that is sustainable, i.e. in NGOs and the private world. Because I've realized that NGOs struggle less in getting finance compared to private or limited companies by shares. Then another thing is the principle of using loan in businesses, because it happened to me, I messed up and learned in a hard way, whereby I started a business with a loan 100%, and then realized it later that the principle is actually meant to be at least 40 to 60 ratio. Like having 60% of money, then I can get 40% of the loan. Another thing is, why don't local farms or local rich men here in Uganda don't fund ideas? I come to ask this for the time I've been trying to go to learn through hubs, both locally and internationally. I realized that most of the people who fund such great ideas come from outside these nations. And for them, they benefit way so much compared to the locals. Another thing as I finish is it a must that every business must pass through the stages without missing any? I'll take an example of the stage whereby each business, as you said, reaches a point of getting a loan. I'm asking this in relevancy to doing business in following all the principles, where you have a business plan, you're picking each data and you're analyzing. Maybe you're getting to be a customer-centric kind of entity that only invests money where it should be. Do I really need, or I should impact it in my head that at some point I must get a loan? Another thing is, why isn't this information shared to every startup? Because for the time I've tried to make an investigation, I realized that it is almost like a trap being set by government, whereby they encourage us startups or youths to start something. Either we've sold land or we've gotten a loan, but we've not been taken through to understand what business is. And at the end of the day, the same amount of money that have been picked is being taken within the same system, and I lose out. Thank you.
Okay, Yvonne, should I respond, or there's also Rigwiza? I wait for the second.
There is Lugwiza, and then there's, I think let's listen to Lugwiza. You respond, then I can read those in the chat. Lugwiza?
Okay, thank you very much, Doctor, and organizing this series. I'm sorry about my background because I'm in theory. Doctor, my concern is about the principle of starting small and growing big. I would love to hear your insights about this, because in most cases, businesses at the infancy level, people are always advising such startups, please try to avoid loans, because you're just starting, keep yourself within the means that you can manage and things of that sort. So I really want to get your insights about that, and still to re-emphasize the question that the previous participant asked about the ratio of loan versus starting. Thank you very much for the presentation. That's my question.
Okay, thank you so much, Robert and Rugiza. I'll start with Robert, and somehow his questions have also rhymed with Rugiza's question, and they've given me an opportunity to explain something. Before I respond directly, let me get this opportunity to explain something beyond what I've just presented. As it is difficult for me to stand here and say businesses must behave like this when it comes to funding, because each entity is unique. It's going to be different from another business. Now, that's where entities like the Management Business Incubation Center of UMI comes in, whereby there is customization to each and every business. For a particular individual to clearly take a decision, you need to provide a little more detail on how that business is operating. And within a business incubation center, you will get an opportunity to be attached to a mentor who would then try to structure what would be the best for that particular business. Now, going back to the questions, Robert asked, what would be the best way of getting sustainable financing, especially for NGOs? That's a very interesting question, because like you rightly stated, our focus usually is on a private entity. So we tend to focus so much on a private entity. When it comes to resource mobilization, where NGOs feature prominently, what matters for sustainability is to identify in a very well specified way the interest of that NGO. In other words, what are you promoting? What are you into? Are you promoting hypothetical good governance? Then that means when you're sourcing for financing, you must look out for funds providers that are in that very sphere or within that space of funding governance or measures that are meant to improve governance. And for an NGO, the best approach is always to look at the long term. In other words, don't rush for grants which are short term, but try to structure the proposals in such a way that they take a bit of time. If you have a 5-year grant, then within those 5 years, you'll have an opportunity to generate another 5-year grant. That is where sustainability comes from. So the principle is to match the interest of the NGO with the funders who operate within that particular sphere. For people to fund, they'll have to make sure that you fit into what they are also interested in. So that would be my comment. Now, on the question of the proportion, again, I'll use an example. There are some businesses which are highly risky, and I'll give you a clear example. Businesses that are in the ICT industry, because ICT or technology keeps on changing on a very, high scale. But there are those which are a little bit low in terms of risk. For example, real estate. Now, if you are looking at a business that is operating in a high-risk venture, then when you are matching the funding or the proportion of debt and equity, it will be different from the other one that is operating in a low-risk venture. Low-risk, a classic example is real estate. For real estate, you can afford to have a higher proportion of debt compared to equity when you compare it with what would be the proportion for an ICT based business or a high risk business. So once more, it is very difficult to say 40, 60. Those are what we call rule of thumb. You remember I explained rule of thumb, meaning there's no scientific evidence, but it is generally taken as acceptable. When you go to the details will actually tell you that it can differ from one business to the other. Why do high net worth individuals in Uganda, why do they shun startups and funding? Of course, largely it's because of the risk appetite. People in countries like Uganda tend to have a low risk appetite, and they are scared of losing their resources. So that's why you find that there are very few business angels in Uganda. Yet there are many business angels who are in Uganda, but they're based abroad. That is more of an issue of risk appetite. They are scared of losing their money, but it could also be lack of awareness that over time, maybe if there's a bit of awareness, it may improve the situation. But I totally agree with your assertion that they actually shun investing in businesses. Is it a must that if a business must go through the stages? No. That is a rule of thumb. Again, I repeat, rule of thumb is something generally acceptable. For example, you may say a child will start by crawling, then they will stand, they will walk, they will maybe talk. I don't know the chronological order, but you may be shocked that one child may skip one of the stages. So it's very possible to skip, and you don't have to be kind of focused to check yourself, where am I? But it is important to know that usually most firms go through those stages. Why is this information not shared with startups? Apologies for that. Of course, now like the Business Incubation Center is trying to do exactly that. It simply means that from our side, we have also failed, but that is part of the reason why we have some of these mentorship sessions. Lugiza asked a question that he wants me to comment on starting small and growing big, and whether small firms should avoid loans. Some have partly explained this, but I also re-emphasize something. It is usually good practice to start small and gauge the risk associated with your business. Now, it's like, I think it's a proverb in Uganda, we're saying in Uganda, that if you are testing the depth of water, you do not do it with both legs. The reasoning behind this is that you never know how deep the water, whether it's a river or lake, is. So you would rather first check the risk and then you get to know how far you can go. So I strongly also support the notion of start small and grow big. And ideally, it would be good to initially avoid loans. Initially, I am not one of those individuals who discourage loans, but before you have tested the risk, be careful because you do not know where you are going. The moment you've established the risk levels, then just weigh your risk appetite and the possible returns that will come from your investment and proceed, whether it means taking loans or whatever source, that is okay. I think I've already emphasized the second bit of it, of ratio of debt and equity.
Okay, thank you so much, Doctor, for responding to those questions. We have Arnold and Mungere Remigius. Maybe we shall have, okay. One of you to go first.
Yes, thank you so much, Bon, and thank you so much, Dr. Paddy, for sharing with us richly like this. I have two questions. One is that I normally hear about organic growth, but I think I've not gone so much deep into it to find what it means, and especially today in relation to funding. What does really organic growth mean in relation to funding, and maybe some of its positive aspects? And then the second is looking at how, you know, the situation or the environment of businesses is in Uganda. Sometimes I feel so much discouraged really about loans. Recently, what is in the papers is about the banks taking late BMK's properties and so on. And that discourages me so much. Do you think really the fault is with these businesses, or actually even generally the government or whoever is really concerned is at fault? When we see big businesses that were employing a lot of people, I mean, being taken by banks and so on, somehow I tend to think that the government could be somehow not really supporting, you know, like creating an environment that would help businesses to remain standing and to be able to continue to, you know, to operate and to employ our people. Thank you very much.
Okay. Remigius.
Thank you very much, Madam. I wish to thank Doctor for that very good presentation he has given us. Just two observations or questions to make. One, generally in our country, it has been observed that most businesses that have started collapse generally after or even before their first year anniversary. What could be the cause? Could it be the way the sources are generated, lack of funding, or some other related issues there behind? And I'm observing that there are many level income earners. Most of them could be having very good business plans, but they have not been able to begin business. I wonder what best advice Doctor could give us. Thank you very much.
Dr. Paddy, let me read to you the ones in the comment section, maybe, and then you respond at once.
Okay, thank you.
Aaron DK says that in relation to Mr. Tinye's remarks, banks in Uganda operate like money sharks, very stringent requirements, very high interest rates, and lack of flexibility, among other things. what would your recommendation be for external funding? Any venture capitalists based in Uganda? Then Tinye commented and said, we sometimes fall in trap because we don't hire right people to assess such things like loans and their impact on the business. They then take an advantage. Then Edith says, the loan interests in Uganda are crazy. Here in Europe, one can get a loan with an interest of 1.2%. The tax rates are too high, yet the social services in Uganda, like free education, health, almost do not exist. That's from the comment section. Dr. Paddy, over to you.
Thank you, Yvonne, and thank you all those who have posed questions and also attempted to respond to some of the queries raised. So I'll start with Arnold's question. He's interested in knowing the meaning of organic growth. Now, organic growth is very near to what Rugiza stated earlier on, that start small, grow big. Organic growth means that kind of growth of a business that is internally driven. So in other words, you start your business, possibly at a small scale, you fund it from your resources, then you keep growing it at a certain level. In other words, you do not rush to bring in external stakeholders. That is how I would describe organic growth. It's a very good approach, but obviously it is a conservative approach, meaning that you take longer to prosper or to grow big, but you also take longer to collapse, because you also asked about issues to do with the environment within which loans are extended. So organic growth is a good measure, but don't become too comfortable, because when you are always in your comfort zone, you tend to grow at a very low rate. But when you're starting off, it's a very good approach. Then Arnold still said that for him is discouraged by debt, largely because of what he's observing in the environment. And this question was, is government doing something about it? Of course, I can't comment on behalf of government, but I can also give some kind of clarification. Yes, it is true that the economy is going through a situation that is not desirable. And this is compounded by very many factors. Of course, COVID was there more than 4 years ago, but the effects of COVID will take long. Now, as particular businesses collapse, there are others that emerge. That is also a natural process. So businesses somehow which were prospering prior to COVID may not be doing well now, but the conditions upon which they received credit or debts were based on the conditions which were holding then, but the conditions today are different. Now, you gave a specific example of an individual or a business that is losing assets. We have so many challenges when it comes to family managed businesses. At times, we do not prepare proper takeover when you are not available. Some of the deeds we enter into are based on the goodwill that we have. Now, when we go away, for example, when someone passes on, the goodwill is also lost. So usually, fund providers perceive a high risk That's why you'll notice there are lots of foreclosures when usually the founder passes on. That is very common because of the as Ugandans. Remigius asked a question that most businesses collapse even before their first birthday. What could be the cause? Once more, I cannot say that these are the scientific causes, but there are lots of possible causes that one can think of. When a business collapses, you cannot divorce the failing of that business from the person who started it. And that means inadequacies in management. Ugandans are very entrepreneurial. We have very many ideas, but when these ideas are being implemented, we do not plan adequately. So something which would have worked may not work simply because of planning. In a very simple way, it is management inadequacies, but this can be expanded to accommodate lots of possible causes. I gave you an example of getting an overdraft and constructing rentals. Definitely, you are going to fail because the funding source is not matched to the possible returns. Also, he asked why a middle income earner is not investing in business. Somehow that is the same question Regiza, I think, asked earlier on. The issue is to do with the risk. People tend to believe that businesses are very risky and they feel they don't want to lose their money. So they tend to look out for safe investments like unit trusts, you take up treasury bills, bonds, rather than investing in businesses. That is the risk appetite associated with Ugandans. Aaron asked if, just in brief, if there are any venture capitalists in Uganda. Yes, there are quite a number of venture capitalists that we have in Uganda. And I think the Business Incubation Center can be of help in this particular regard. It would all depend on what you want to invest in, then matching would be done to the potential venture capitalists that, I mean, the ones who operate within Uganda. Tinye's comments, I totally agree with them because I think those were comments. And that's the same with Edith. What I can say is that, yes, in a number of countries, the interest rates may be low. That is largely because what we call, if you are looking at the US, that is the Federal Reserve, I mean the Federal Reserve rate, yes, or what you call the bank rate in Uganda. So you'll find that I think in the US should be around either 1 or 0.5. So obviously, the interest rate charged on loans would be very close to that. Now, ours in Uganda, I think now it's in excess of 11%. Definitely, the interest rates will also follow that. So it is true. I also agree with Edith that in certain economies, the interest rates are way, way lower than what we have in Uganda. Thank you so much. I see a comment. I think you can allow me, Yvonne, to respond. How does one identify the right business venture? It depends on what you want as a business. In other words, remember, a business, I mean, a venture capitalist will be interested in your idea. So you must present your idea and they buy in. So it's more of them than you. All you have to do is to present to them your idea. If they buy into it, then they will invest. So it starts from your business idea, then we move to the business venture. Thank you. I hand back to you, Yvonne.
Well, I'm tempted to bring this to a close, but we have some questions here, which I think we can summarize them. Someone is asking, what business should one invest in which has low risks? I think Doctor has kind of hinted on that. Then we have Isaiah asking, saying thank you very much for the presentation. What are the conditions for accessing the Business Incubation Center? That one I will respond. The Incubation Center is at Uganda Management Institute. When you get there, you ask for directions to the office and I will attend to you. Then he continues to state that his experience is the challenges of making the business break even. As you rightly observed, as businesses grow, they may require more capital to grow and break even. And that could be one of the challenges why the business fails. What are your observations on factors that influence business break even? Then we have Bridget asking, how does one identify? I think that one you've responded. And Arnold says, thank you very much for the enlightening presentation. I think that's it. Doctor, over to you. And then we shall bring
Thank
it
you.
to close.
Okay, thank you, Yvonne. I'll respond. I think there are only 2 questions. I didn't get who asked the question on what business to invest in with a low risk. So I'll just respond to it outrightly. Then the other one was to do with my observations on break even as a challenge. Okay. One, I want to encourage you to not go by what people normally say. So, for example, it is a very bad idea for you to jump into a business simply because they've told you it is a good business. I've heard of so many people saying, salons are doing well in this area. I think I should start a salon. That is dangerous, because it means you are going into something that you do not know. Now, what defines risk? Risk is simply the probability of losing what you invest in. And every one of you can easily define risk in your own way. For example, definitely even within the transport industry, a taxi will have a lower risk than a bus, yet they're all into the transport industry. So when it comes to risk, you need to be aware that low risk investments also bring in lower returns. What I can say is one of the ventures with the least risk, assuming you manage everything well, is investing in real estates. But that makes an assumption that you have done your due diligence, because you can still go wrong even in a low risk venture. So any venture or business where there's a high probability of losing your money would also mean there's a high probability of getting back your money quickly. That is a high risk venture. Any business where there is a low probability of you losing your money, it will also mean there's a low probability of you getting your returns quickly. That is a low business venture. Now, it will be difficult for me to direct you that go into this business or the other. What I would emphasize is, please don't look out for what others recommend. Usually, look at your interests. Start from your interests. What do you like doing? Do you like farming? Do you like traveling? Do you like, if you like traveling, then you can easily do business in tour and travel industry. If you like cooking, then catering would be okay. And for you to weigh risk, simply look at the probability of losing your money, which would also mean if it is high, then also the probability of getting back your money will also be high, because risk and return usually move in tandem. So that is for the first question. The other one was another comment where I was requested to talk about my observation on break even as a challenge. Yes, of course, break even for members, you never know, just in case some are not aware. Break even means that point where at least the amount that you are earning is equivalent to the amount that you are spending. So it is from that point that you can say, I've started generating a return. So what you are spending is at least matched to what you are receiving in terms of revenue. This is a very key point in finance, because prior to you reaching a break-even point, you are making losses, you are injecting in. Then immediately after, you are generating a return. The rate or the speed at which you move towards break-even will also be defined by the industry where you're operating. Like I said earlier on, a farm in oil exploration will take longer to break even compared to a farm that is dealing in grocery or even a supermarket. It is going to take a shorter period for such a farm to break even. Now, where is the problem when it comes to business failure? You need to plan adequately. If it's going to take you long to reach break even, then you must structure your funding sources in such a way that they keep running until such a time when you are generating a return. So the funding sources should now help you to move towards break even. Farms that collapse are those which fail to exist until when they pass the break-even point because of either poor planning or for unforeseen circumstances. COVID struck, people had planned, but definitely they had to extend their break-even point or break-even, the time they'll reach that break-even point. So you have to plan adequately and make sure that you know, at least you have a reasonable level of certainty when you break even, and then you plan accordingly. So that would be my honest view regarding the challenges associated with business break even. Thank you. Back to you, Yvonne.
Thank you so much, Doctor. Looks like you've tickled so many. We have Daniel Mulindwa. I presume this is the last one. How does one build a strong business case? From experience, many of us start businesses without a clear business plan, which hinders us from demonstrating strong financial projections. Elaborate a little about how the incubation center can be helpful to peasants like me who lost a supermarket business recently.
Okay, thank you, Yvonne. Thank you, Daniel. Now, building a strong business case. This is what I'm going to say, honestly. Usually, entrepreneurs are different from individuals who are more comfortable as employees. People will tell you that for adequate success, you must come up with a clear plan, come up with strategies, then go ahead and plan for acquisition of resources, and you proceed to investment. With an idea, immediately they start looking for money. They start, if you remember that continuum, looking for money from family and friends, and then things work out along the way. Of course, I'm not going to be at the extreme point of the continuum and say you adopt this or the other. However, what matters is this: wherever you are, whichever way you have started, make sure that you have what is supposed to be in place in order. For example, I remember last week we had someone from URSB. That is to do with regularization. Be known by the law, because you will not prosper in a country where you are not known by the law. Then as you are operating, you are going to come across different opportunities. Those opportunities are going to demand for certain things to be in place. When you are bidding, they're going to ask you for your tax clearance certificate, meaning you must clear with URA. As you are bidding, they're going to ask for audit reports. At the infancy level, these will not come. But as you develop and grow through the different stages, then you also continue building on the experience that you've gained. So in other words, what I'm trying to say, it is very good to get organized, but it doesn't mean that if you are not organized, you are going to fail. Just make sure at whatever point you are, you do adequate planning and legalize your existence to make sure that you can take advantage of the opportunities that come your way. On the issue of how the incubation center can be helpful, the incubation center, I think Yvonne has hinted on this. It has lots of services that it can offer. For example, there are connections with URSB. You may be having your business idea, but you do not even know how to go about it. For them, they can call someone and say, okay, so-and-so wants to register business. What do they do? How can we guide them? There would be a mentor that will take you through. You may be interested in filing tax returns. You've had recently, IFRS is scattering everyone here and there, but it's more of understanding. They would be able to mentor you, to advise. So regardless of where you are operating from, as long as you are interested in regularizing your existence, the Business Incubation Center would come in handy. Back to you, Yvonne. Thank you.
Thank you so much, Doctor, and participants for being with us for this time. This time we have actually shot overboard. The sessions are supposed to last an hour, but I would request that those with questions to revert them on the phone numbers that are on the flyer that has been widely shared for today's session. And those questions will be attended to, or you can leave your email behind in the chat, and I'll be able to add you to the mailing list for further communication, and you can always send your questions or your queries through the email that will be communicating. I request that these sessions, we still have 4 sessions to go, and we'll be using the same link. And next week, we'll be handling leveraging the digital space. So I look forward to having you on board in next week's session. Thank you so much, Dr. Paddy, for sharing with us and selflessly explaining and helping out, and also answering the queries that were presented. Thank you so much, and I would like to bring this to a close and wish us a good night.
Thank you, Yvonne.
Thanks very, very much, Yvonne.